What is going on, traders? Apologies for not going live earlier today. I was supposed to go live for the CPI. However, I was feeling a little bit under the weather, had a range of cluster headaches, but I'm all fine now. So in this video, we're going to dive into the CPI report. What does it mean for the Fed funds rate? And more importantly, what does it mean for your portfolio? There is definitely some good in it, but there's also some things that are concerning that I think will also be concerning to the Fed. And then obviously we'll dive into the chart here as we see the S&P 500 failed to stay above this trend line that we've been monitoring really for a few months now since the bottom in October. So I'll give you my plans from a hedging perspective, what I'm planning to do here, and then I will also go over the plays from the CPI report because we did have a play on CPI and we will likely also have a play on FOMC, which is the Fed meeting on December 14th. So a lot to get into today. Apologies again for not being able to go live earlier. And just a reminder that if you're watching this before December 17th, we actually have a webinar, a free webinar. This is our mastermind call that we do a couple of times a month with our Academy Pro members and our Academy Lifetime members as well. We're opening this one up to the public for the first time ever. Here are the topics for the mastermind: how to trade like banks, futures versus options, how to size your trades, and when to take profits. We've already had over 1,000 signups for this. Check the link in the description for spots. Like I said, it is absolutely free, so you definitely want to sign up. And I will see you guys on December 17th at 12 p.m. Eastern. You definitely don't want to miss it. It's going to be extremely lit. Without further ado, let's get right into it. Everything CPI in this video right here. Let's go. All right, so the CPI, the expectation was that we would come in at 7.3% year over year. Came in a little bit less than that at 7.1% from a year ago. So a good sign that inflation is, as a matter of fact, peaking and trending downwards for the second month in a row after hitting a high of over 9% earlier in the summer. Now, this could be a little bit confusing because the year over year number is down. It doesn't mean that inflation isn't rising month over month. Core CPI rose 0.2% over the month. Now, core CPI strips out energy and food, and this is the metric that the Fed claims that they look at more than the actual CPI number. Before we get into what this means for the stock market, I want to dive a little bit more into the CPI because I think that there is some context here, and the reason why the market gave up a lot of its gains already after shooting up 3 to 4% earlier at the open. So if we dive into the CPI a little bit more, specifically the core CPI, which the Fed looks at more closely, we could see that services inflation is actually really sticky. Also, inflation for groceries, apparel, and communication increased from October to November. And services such as airfare is up as well. Now, the reason that service inflation is still high is because services are tied directly to wage growth. And as you know, unemployment and wage growth have been really sticky. The Fed has been trying to increase unemployment and tamp down wages. And so far, they haven't been successful, even after a 25 basis point rate hike, 50, 475s, and they will likely do another 50 in December, on December 14th, a day after this recording. So the Fed actually has a long way to go still. So the question becomes, how much does the Fed continue to hike? How long they're going to keep interest rates there? And we will likely find out more of this during the Summary of Economic Projections, or SEP, which is set to release on the same day that the Fed is going to tell us about the interest rate hikes on December 14th during the FOMC meeting. We're going to also get a summary of economic projections, which will give us more context as to the terminal rate meaning the rate at which the Fed will stop hiking, and potentially how long they will keep the rates at the terminal rate, how long they're expected to do that. So I definitely want to talk about where the market is projecting the Fed terminal rate to be and what has to happen over the mid to long term for the Fed to actually pivot. But before I get into that, let me give you our CPI plays. So I posted this on Twitter. By the way, follow me on Twitter and Instagram where I send out daily free finance and trading content. But I was saying on Twitter that while everybody was guessing on the direction of the CPI, some people bought a shitload of calls, some people bought a shitload of puts. You can employ a little bit more complexity to your strategies by buying something like a strangle. So we bought a $10 wide strangle, the 279 put plus the 289 call. not needing to guess which way the stock market was going to go. We just needed the stock market to make a larger than expected move. It opened up, like I said, almost plus 4%. We did this on the triple Qs, ended up netting a little over 50% on this trade. Now, it's not going to be as much as if you bought naked calls, but if you bought naked puts, your puts ended up at 0%. So there is a trade-off there where it's a risk to reward trade-off, right? You're taking on less risk by buying both a call and a put. But if the market makes a big enough move in either direction, you get to profit. And this is just scratching the surface of the type of analysis and plays that we provide in the academy, as well as what we talk about on the Zoom calls. And we go over on the Zoom calls where we answer all of your questions regarding complex strategies like this that usually people don't, especially beginner traders, don't really know about. They think that they're relegated to just buying naked calls and puts and guessing on what the market will do. So we will likely open up another strangle right before FOMC, taking advantage of this data right here that one of our analysts put together. Shout out to our analysts on the Discord. But usually after 2:30 Eastern time, after Powell stops talking, we tend to get huge moves in either direction. So we will likely be playing a strangle on this as well as some other day trades. If you want access to all of our analysis and plays and the Zoom calls, you want access to the options course, the day trading course, all of that good stuff, we are going to be raising prices in 2023. So make sure you lock in that end of year pricing before the prices go up in 2023. Book a call with one of our ambassadors. They will definitely take care of you. In my view, it is well worth it. You get so much value. Again, whether it's the courses or the Zoom calls or the analysis or the plays that we're very transparent about. We put out a report every single week about the performance of our plays as well. All right, so let's talk about the federal funds rate. So if we take a look at the Fed funds futures, right now, the market is projecting that the terminal rate will be at 4.88%. If we look at the current rate, where our target range right now is 3.75 to 4, and we're right around the 3.83%. So we have about another percentage left thereabouts if we are going to get to that terminal rate that the market is expecting. Now, it doesn't mean that we'll stop at 4.88. A lot of analysts are also predicting 5%. Here's what has to happen, though. What's going to dictate the terminal rate is how fast inflation drops and what the CPI actually is. Because if we take a look at this chart here from Bloomberg, and there's a mistake on this chart, by the way, but if we take a look at this chart here, you'll see that the Fed funds rate has to be above CPI each and every single time that inflation was a problem. If we take a look at the last 8 rate hiking cycles, the Fed funds rate has to be above CPI for the Fed to stop hiking and start loosening again or pivoting, right? So in this case, and I say there's a mistake here because the black and the pink is supposed to be switched. So the black is actually the CPI and the pink is the Fed funds rate. So the Fed funds rate has to get above CPI before the Fed even considers pivoting. Right now, CPI is 7.1%. Fed funds rate is 3.83%. So the CPI is trending down and the Fed funds rate is trending up. We have to get to a point where they intersect and the Fed funds rate is above CPI. So where is that? And that is what the Fed funds futures market is projecting, that the Fed funds rate is going to be at 4.88%, at which point CPI will likely be below that, and that is the point at which the Fed will actually pivot. So what this means for your stocks is that there's actually quite a long road ahead of us, right? Inflation is proving to be very sticky. Like we're at 7.1%, where we actually started the year. So it's not like it's dropping like a rock. Inflation is definitely peaking, but it's still rising month over month, right? And we saw the numbers as it relates to some of the sectors, especially in services, because that is tied to wage growth. That inflation is also proving to be sticky. So it's not like inflation is dropping like a rock. And we are still at resistance here on the S&P 500. So in my view, there is still quite a bit left because we need unemployment to go up. We need wages to go down. When unemployment goes up and wages goes down, what happens to earnings? Well, earnings are going to take a hit as well. So companies are going to report less earnings. They're going to give worse guidance. And we're going to see those valuations drop some more due to what is called earnings compression. As I said before, the only way that this was the bottom here in early October is if inflation magically drops like a rock, which has never happened before, and we have no reason to believe will happen now. So the Fed is actually needing to engineer this recession in order to make sure that inflation gets to that 2% target rate. Remember, they want to get to 2%. And even if inflation stops at 4.88, or the Fed funds rate stops at 4.88% or 5%, that doesn't mean that it's going to get there and then the Fed's going to pivot immediately. They might need to keep rates higher for longer, as Jerome Powell has stated time and time again, until the Fed funds rate is well above CPI. This has been the case every single time inflation was a problem. This has been the case the last 8 rate hiking cycles, that the Fed funds rate has to be above CPI. So until we get sort of confirmation that that is the trend, because right now we just have 2 months of slightly declining inflation year over year, but inflation is still slightly rising month over month, right? Until we get a confirmation that that is the trend, I don't think that we see a bottom in the stock market yet. We could revisit these October lows, but my ultimate target for 2023 is the pre-COVID highs, which I think we could easily get to. Again, barring a miraculous event where inflation just drops like a rock out of the blue. So I think it is largely expected that on December 14th, Powell is going to do a 50 basis point rate hike. That's 80% likely. I don't think he'll do 75. I think we'll do 50, potentially 25 in January, 25 in February, and then pause. Right? Well, because that'll be a full basis point rate hike. 50 plus 25 plus 25 will get us to near this 4.88% here, right? And I think at that point we will pause and hold and see what happens with inflation. And hopefully the economy is not completely shellacked at that point, right? Hopefully unemployment doesn't have to go up that high. But as is the case with these things, and you know I've covered this before, we've never achieved a soft landing. The Fed has never achieved a soft landing. So that is something that we have yet to see. And we haven't even talked about the Fed's balance sheet, which the Fed is actively shrinking as well. What is that going to do to the Treasury market? It is already doing a number on the yield curves. The inverted yield curves are more inverted than ever historically, where the short-term treasuries are paying more than the long-term treasuries, right? So we still have that as well. So I think we're quite far away from, this right here being the bottom, in my opinion. And if Jerome Powell does a 50 basis point rate hike, or, more unlikely a 25 basis point rate hike, and we do see a little bit of rally up here, I will likely open up another short for 2023. We are already starting to see a lot of shorts opened for 2023 and beyond, right? So I do think that there is an opportunity to hedge there, either with credit call spreads or, leap puts. I will definitely be sending those out in the academy. So if you're a member, look out for those. Along with our continued analysis. Remember, if you're seeing this before December 17th, register for the free webinar where we'll go over those fabulous topics that I outlined in the beginning of the video. That is something that we do regularly. So that is why I say that the Academy brings so much value, because even if you just look at the Zoom calls that we do a couple times a month, that in and of itself, answers a lot of questions and fast tracks a lot of new traders, especially regarding complex topics that usually take months or years of trading to learn. You get to ask the community any question you like live and get your answer right there. So even if it's just for the Zoom calls, but you get access to the courses, the analysis, the alerts, the other analysts' analysis. So book a call with one of our ambassadors if you're interested in joining, because I will be sending out those hedges as well. And any FOMC plays that we play on December 14th. If you got anything out of this video, leave it a big fat thumbs up. Again, apologies for not going live earlier. Wasn't feeling too good. Still not feeling that great, honestly. Hope to go live during FOMC as well. Stay safe out there, traders. Peace.